Hello and welcome to our quarterly webinar on insurance market price movements. We're having a few technical challenges at the moment, uploading my slides, but hopefully that will be done in the next minute or two. In the meantime, I'll give you a bit of background into what it is that we're doing and who we are. So we are Pearson Ham, and our mission is to help clients improve performance through better pricing, and we do that in several ways. Current projects that we're working on include helping clients think through effective responses to the upcoming regulatory changes and developing effective pricing strategies for that, providing support with improvements to trading agility and being able to respond and react to market changes. And that includes the team structure, processes and governance that sits around that, and developing pricing strategies for multi-channel approaches. So where insurers are acting as both wholesalers to the brokers and retailers selling direct to the public. We also provide insights on market and competitor price movements, and that's what we'll be looking at today. I'll go through some of the methodology as we wait for the slides to load. So the data that we'll be looking at today is based on our consumer panel, and we have recruited 3,000 people on car and 3,000 on home insurance, and have their permission to run their details through the price comparison site. So we've got arrangements in place with the big four aggregators, and they allow us access to be able to collect price information, and we use that to create reports for our clients, which enables them to have a clear view of what's happening in the market, when competitors are moving prices, and how that might impact on their performance. This is provided on a daily basis, so the frequency allows very quick and speedy responses to any market movements that are observed, and provides enough information to be able to make informed decisions alongside other data sources. Apologies, we're still waiting for the slides to load. For anyone that has joined us in the past few moments, we are having some technical difficulties in getting our slides to load, and that's what we're waiting for at the moment.
Stephen, I'm going to try and upload it as a PDF rather than as a PowerPoint.
Okay.
It's a smaller file, so it should load more quickly, but
Okay, apologies to anyone that's joined us in the past minute or so, but we are having technical difficulties in getting the slides loaded. So we hopefully will get that done as soon as we can in the next minute or two. There we go. Great. So I've given a bit of an introduction into who we are and what we do. If you want some more information about Pearson Ham and our market insights, then please click on the link. That will take you to a PDF document with more information on the services that we're able to provide. I've talked about the methodology and the approach that we're taking. And here are some of the example insights. So let's get straight into it. So motor insurance, what have we seen in terms of price movements in the past 3 months? So looking back at Q3, and this is what we've observed. So prices have continued to drop. Each month, we've seen a consistent reduction of around 0.5%. This is not as much as earlier in the year, but a bit of a sharper drop than we were observing in Q2. So I don't think the expected rise in claims frequency is coming out of lockdown is quite as bad as it might have been, and that there are still some positive margin benefits from last year, which could be enabling the reductions. So all in all, we've come down by about 1.7%. in Q3. This means a drop of over 7% since the start of the year. And we were expecting to see some increases into the second half of 2021, but these haven't quite materialized. So potentially some tough trading conditions. This makes prices around 11% lower than the same time last year. And if we put this into the context of what was happening, then we were in the midst of the pandemic and have been going through a period of intense price competition in the market. And prices had been dropping since about April on 2020. So if we were to take this trend back and look at over the past 18 months, then we're probably looking at price drops of around 15 to 16%. So really significant movements over that time within the market. So looking at the average, it can often mask underlying activities by individual insurers. So it's worth taking a look, and we're looking at some of the main providers through the price comparison sites at the moment. And if we drill down into some of these, what do we see? Well, the average movement of the kind of the top 5 best prices, how does that reflect the individual strategies that we're observing? Well, what we're seeing here is continuous reductions for many of the large players, with some differences in approach. So Insurer 4 on this chart, for example, was much more decisive early on in the year and put larger reductions than its competitors in. And has actually been increasing prices more recently since March. However, the overall price difference at this point from the start of the year is in line with the average reduction. We've seen other insurers trying to increase prices. So this chart shows another 5 of the top 10. And from Q2, we saw some rate trying to go back into the market, which has leveled off somewhat in Q3, or has reversed, and price reductions have been applied again. And these could either be strategic moves to put some new business rate back in ahead of the January pricing remedies, or forced by loss ratios getting into uncomfortable levels following a year and a half of price cuts. Whatever the case, the increases haven't carried on past Q2. So I think overall we're seeing average price movements coming down, and those downward movements broadly being reflected in what we're observing for the main comparison site providers. On home insurance, we look at what are we observing there. So looking at a combined cover year to date, prices are down by about 5%. So again, this follows price reductions in 2020. So the biggest reductions that we've seen so far this year have been more recently in Q3, prices dropping by about 2.5% over the last 3 months. And home is an area that we would expect to be most impacted by the upcoming pricing remedies in January, and where we might have expected more acquisition price increases to start flowing through at this stage. However, this hasn't been the case, and again, potentially tough trading conditions for insurers within that market. So there's not much out of the ordinary happening at an individual insurer level. So looking at some of the top providers here, we're seeing downward movements between 5 and 12%. So some insurers are putting in larger cuts than others, but the general trend is a downward one and reflects what we're seeing at the overall top line level. And again, here are 5 of the other of the top 10 home insurance providers, and we're seeing reductions across the board, albeit to different extents. And what's interesting looking at home is that there's been very few efforts to increase prices. So whereas if we look at motor, a few of the providers have made attempts to put some rate back in. We're seeing less of that happening in home. And interesting, as I say, when we're looking at how we expect the new pricing regulations to impact, and on home in particular, where we were expecting a bigger impact, and potentially looking at some price increases as we move through the year. So again, that's not what we're seeing. Prices have continued to drop in motor and in home combined. Having a quick look at contents only. So we're seeing a very similar trend there. So larger price reductions have been applied in contents only than in combined cover. So prices down by about 8% year to date. Again, this follows a period of price cuts towards the end of 2020. So looking at it over a slightly longer period, then there's a drop over 12 months of closer to 10 or 11% on contents only. Okay, so that's what we've observed so far in Q3. I'd like to kind of revisit my initial forecast that I made in terms of what I expected market prices to do in motor at the beginning of the year. So from Q1, this is my original guesstimate as to what I expected might happen in the market. So there were 3 scenarios that were put forward. What I did expect was prices to come down or start to level off towards the middle of the year, and then at some point to start to creep up again ahead of the regulatory change impacting in January. So expecting a bit of a rebalancing between renewal prices and new business prices to start to impact in the second half of the year. This is what we've actually seen. So up until August, the trend was in line with my scenario 1. So this was the lowest case where prices were expected to come down to about 5 or 6% below where they were at the beginning of the year, and then start to pick up again. Actually, in September, prices have continued to drop, so we haven't seen that turnaround. So we are now at a lower point than the lowest scenario that I was thinking about at the beginning of the year. What do we expect to happen for the rest of the year? I think at this point, I'm not expecting any increase in rate over the next few months. So I think the most optimistic scenario we're thinking about is a leveling off, maybe some slight reductions. And it may be the case that depending on how impactful any change in claims frequency has been, if that is starting to flow through for certain insurers, then we may see that leveling off, or if the benefits are still in place from the lockdown periods, it is possible that prices could drop even further before the end of the year as we go into January. So that's what I had previously said, and what we've been observing to date. Looking ahead, what do we expect to happen over the next few months and into 2022? And I think it's a very difficult one to predict, which is no surprise, I'm sure, to anybody who's listening. So looking at the market context, we would expect price increases to start to be implemented early in 2022 when the new regulations are in effect. Looking at what the potential causes of some of those increases might be. So on the face of it, we would look at it and say, yes, prices have to increase. Mix changes could result in higher risk business on the roads. So the impact of coming out of lockdown and changing customer behaviors in terms of working from home and those who are commuting. Driver experience being reduced. So having gone through prolonged periods of lockdown, people are not as used to driving as they would have previously been. So there may be room for errors and mistakes resulting in accidents. And new drivers coming onto the road. So where previously people may have been traveling to work on public transport, they may be more likely now to be driving. So people with less experience driving, as well as those people who are normally driving, having reduced experience through lockdown periods. Cost of parts has increased. So we can see this, and caused by both Brexit and the pandemic. So the repair costs are increasing, and logistics. So the logistical challenges of moving parts around are also contributing to this increase in costs. So we've got some cost elements and potential loss ratio impacts, which we would expect to force prices up. We've then got the impact of the regulatory change. So that kind of rebalancing. So renewal margins are going to be squeezed tight due to the new regulations and reductions in the prices that are being charged. LTV models may not be assuming as much outer year value and trying to claw that back in terms of year one margin and doing that through increased rates. Year on year price changes could increase switching. So that again could be driving prices, and a rebalancing of new business versus renewal prices should, all else remaining equal, result in a drop in renewal prices and an increase in acquisition prices. So with all of this going on, we would expect to see increases and potentially in Q1 of up to 5 to 10% as we start the year, and by the end of the year between kind of 12 to 15% potentially, in order to account for these things that we're seeing. However, it may not quite be as straightforward as that. So again, just to recap the upwards pressure, so there are several factors that we're looking at, which we would expect to be pushing prices up. So we've got claims inflation, increased frequency of claims, rising costs of parts, logistical challenges from the repairers. And we've got the FCA pricing remedies. So really a kind of a rebalancing of acquisition and renewal prices is expected to put those acquisition prices up. However, there are other factors which might dampen any price increases that we're seeing in the market. So we have seen more tiered products appearing, allowing lower acquisition prices to be maintained without the challenge of the renewal equivalence. So where the regulations are saying the renewal price must be no higher than the equivalent new business price. Well, if there's a new product in the market, as long as that is kind of acceptable and there's a reason for it and it meets customer needs, then that's fine. It doesn't need to be equivalent because that's something that's new. So potentially prices could remain lower through some of the new tiers that we're seeing appearing in the market. New propositions as well, such as pay per mile. So we've seen significant growth in both the number of providers out there and the demand for this type of policy. So by miles, we've seen kind of in many partnerships over the past few months with a number of our kind of traditional big name insurers. There's also positive benefits from whiplash reforms and the MOJ portal, which could be playing a part. So where we are seeing benefits there, then that could help to kind of keep premiums low and kind of dampen the expected increases based on those other factors which we've looked at in the previous slides. As of yet, I'm not sure we are quite seeing the increase in claims inflation that was expected coming out of lockdown. And I think that's something which has enabled insurers to continue to reduce rates throughout the year, and particularly in Q3, and which may enable them to continue to do so in Q4. And it's something that might help to dampen the price increases. So where we're looking at potentially 5 to 10% in Q1 and 15% by the end of the year, that's kind of all else remaining equal. If we didn't have these additional downward forces, is what we would expect. But with these competing and clashing upwards and downwards forces at play, then it's really difficult to be able to say what we expect to happen. So I think we'll look at what comes up over the next few months and take it from there. There are also other influencing factors which need to be taken into consideration. So new vehicles is something which we've seen a kind of a massive drop in the number of new vehicles being manufactured and registered and purchased. So this should be a consideration in terms of pricing. So a lot of this is driven by shortages in microchips and semiconductors that are needed in the manufacturing process. So the pandemic has hit and impacted the parts that are needed, which has slowed down on the production. This has also had a knock-on effect into second-hand car sales. So there's been a massive spike in the purchase of second-hand car sales. So this, I mean, we've got the kind of the reduction in new vehicles being manufactured and purchased, which is impacting on this, but also changes in customer behavior. So people previously who may have been taking public transport now driving to work are kind of purchasing these vehicles. So are the right assumptions in place and the predictions that come from historic modeling based on vehicle age, are they still valid, or should those be reviewed in any pricing models which are currently in use? We're also seeing rapid growth in new technology, in particular electric vehicles. So many insurers may not have the right underwriting rules and or pricing in place to take advantage of this opportunity. So I think in summary, there are a lot of moving parts. It's an unprecedented time within the industry. There are so many things going on, forces pushing prices up and forces pushing prices down, and a lot of other factors which are changing, which are making the future much less certain than it may have been in previous years. So putting pressure on some of the predictive modeling that is being done based on historic data, because the future isn't going to be the same as the past. So all we can do at this stage is to keep monitoring the market and maintain the ability to react and adapt pricing approaches where necessary. So we will be back in 3 months' time with a view on what we've seen throughout the rest of this year and looking forward to 2022. So I'll attempt to have a go at predicting what we expect to see in 2022 when we have the next session. At this stage, I'll just move on to our Q&A. So if you do have any questions, then please log them in the chat. I think there are already some which have been asked during the presentation, so I shall address those now. So the first one is, your previous views were that we'd have seen price recovery by now in 2021. What's caused the difference between expectation and reality? So I think it is around the claims inflation. So there was an expectation that we would reach a point where it would be unsustainable for insurers to reduce prices any further. I don't think we've seen the claims inflation that was expected, so that's enabled price reductions to come down further. I think also we didn't factor in the additional lockdown period at the beginning of the year, so that again there was the kind of the claims frequency benefit of that. So I think some things changed slightly, which have resulted in insurers' ability to continue to reduce prices. Do you expect to see a drop in customer shopping around activity next year? I think that possibly. I think probably not until later in the year. I think when we look at books of business, there tends to be a drop in retention or an increase in switching activity, where prices diverge from the price that was paid the previous year, even if the price is lower than the previous year. So I think there may be some big differences between what was paid last year on the old basis and what's going to be requested at a renewal on the new basis. So that could trigger some shopping around activity. The switching will depend on whether there are still any good deals available for those customers in the new business market. So that there probably will be at the beginning of the year as things stabilize. So I would expect there to be shopping around. That would continue. Whether switching would increase or not, that's yet to be seen. Okay, so that brings us to the end. So if you'd like some more information about what we do and how we may be able to help you navigate through the current situation, then please feel free to contact me directly, or you can download our insurance pricing guide here via the link that's now being shown. And thank you. So yeah, if you want to get in touch with me, then you can contact me directly. As I say, Stephen Kennedy at pearsonham.com, and I'll be happy to answer any questions that you may have. Great. Thanks very much, and apologies for the technical difficulties that we had at the beginning of the presentation.